Welcome to MBA 620, Financial Decision Making. My name is Dr. Richard Works, and I will be your instructor for the course. The goal of this course is to think like a CFO of a firm, to equip you with a way of thinking informed by academic disciplines of economics, finance, and accounting. For example, which one of the following should be the goal of a firm? To maximize sales, to maximize market shares, to maximize profits, or to maximize shareholders' wealth? The answer is to maximize shareholders' wealth. To do this, future cash flows must be considered, as well as the timing of those cash flows and the risk associated with having to wait for those cash flows. Maximizing the price of a firm's stock will maximize the value of that firm and the wealth of its shareholders. A positive cash flow may be paid to owners as dividends or invested back into the company. The larger the positive cash flow, the greater the value of the firm. On the other hand, a negative cash flow over the long run will lead to bankruptcy and closing a business. Here we see a simplified corporate organization chart. As we drill down into this chart, we are mainly focused on the financial occupations. So this course will teach you to think like a treasurer, a risk manager, a controller, and an internal auditor. In this course, we will be focusing on three things: working capital management, capital budgeting, and financial decisions. The working capital management considers the current assets, which include the cash, the inventory, and the accounts receivables. The capital budgeting includes the productive assets, which includes the plant, the equipment, the buildings, the technology, and the patents. And as we discussed before, all of this is to increase the wealth of the stockholders. Three key financial decisions. First, capital budgeting. Choose the long-term asset that will yield the greatest net benefits for the firm. Second is financing. Finance assets with the optimal combination of short-term debt, long-term debt, and equity. And third, working capital management. Here we will adjust current assets and current liabilities as needed to promote growth and cash flow. How the financial decisions affect the balance sheet. Working capital management decisions deal with day-to-day financial matters and affect current assets, current liabilities, and net working capital. Net working capital is the difference between the current assets and the current liabilities. Capital budgeting decisions determine what long-term productive assets the firm will purchase, and then financing decisions determine the firm's capital structure, which is the combination of long-term debt and equity that will be used to finance the firm's long-term productive assets. Now we come to Project 1, Applied Economics for Managers. The first part of our Project 1 will be to discuss the skills gap analysis, which you may remember from MBA 610. On the skills gap analysis, review each item and determine your current level of proficiency and the importance the item has for your career success. Use a scale of 1 to 7, where 1 is low and 7 is high. On the file, overwrite the sample ratings with your own ratings for the item. The gap will automatically be calculated. Interpreting your results. In the example, the gap is -5. The large negative number indicates an item where current proficiency is low and career importance is high, so this might be an item that you would want to address. A gap represented by a large positive number indicates that proficiency is high, but career importance is low, so in this case, you might not want to address this item in this course. Afterwards, use the text box at the bottom of the page to write a reflection of no more than 200 words describing the gaps you will work to reduce this semester, why you selected them, and the activities you will pursue to develop your selected competencies. Application of the skills gap analysis to business. Developing a skills gap analysis typically involves defining the skills and the knowledge required to complete a task, and then comparing a person's current level to that requirement. Determining the required skill levels usually includes defining the job responsibilities when companies introduce new technologies or processes. Step 2 is to analyze the supply and demand graph. Demand is defined as the quantity of a good or service that buyers are willing and able to buy at a particular price during a particular period. The quantity demanded of a good or service is the quantity buyers are willing and able to buy at a particular price during a particular period, all other variables unchanged. A demand schedule is a table that shows the quantities of a good or service demanded at different prices during a particular period, all other things unchanged. A variable that can change the quantity of a good or service demanded at each price is called a demand shifter. Here is an example of a demand schedule. If you notice going from left to right that the demand curve is downward sloping. In this example, we see at $5 that we can only sell a quantity of 10, but as the price decreases, for example, to $1, then we can sell 50. The determinants of demand include the income, the price of the related good, the taste or preferences, the expectations, and the numbers of buyers. Supply is defined as the quantity of a good or service offered by sellers that are willing to sell at a particular price during a particular period. The quantity supplied of a good or service is the quantity that sellers are willing to sell at a particular price during a particular period. In general, when there are many sellers of a good, an increase in price results in an increase in quantity supplied. This relationship is also referred to as the law of supply. A supply curve is a graphical representation of a supply schedule. It shows the relationship between price and quantity supplied during a particular period. Now we saw that the demand curve was downward sloping, but the supply curve is upward sloping. In this example, when the price is $1, suppliers or sellers are only willing to sell 10. On the other hand, when the price goes up to $5, then sellers are more willing to sell more. The determinants of supply: input prices, technology, expectations, and the number of sellers. Equilibrium is formally defined as a state of rest or balance due to an equal action of opposing forces. In economics, these forces are supply and demand. When supply and demand are not in balance, economic forces will work until the balance is restored. This is a table like you will be working with in Project 1. Here we have the price, the quantity demanded, and the quantity supplied. And to find the equilibrium, you have to find where supply equals demand. This is the same information, but on a graph. And again, the intersection is the equilibrium. Here we will show you what happens when markets are not in equilibrium. In panel A, there is excess supply. Because the market price of $2.50 is above the equilibrium price, the quantity supplied exceeds the quantity demanded. Suppliers try to increase sales by cutting the price, and this moves the price toward its equilibrium. In panel B, there is excess demand. Because the market price of $1.50 is below the equilibrium price, the quantity demanded exceeds the quantity supplied. Because too many buyers are chasing too few of these goods, suppliers can take advantage of the shortage by raising the price. Therefore, in both cases, the price adjustments moves the market toward equilibrium. The supply risk includes shortages, price increases, quality, availability, and political and social unrest. Demand risk includes demand shortfall, latent demand, seasonal demand, excess demand, and demand volatility. Step 3 is to analyze cost, pricing, elasticity, and the production function. To show how responsive quantity demanded is to a change in price, we will apply the concept of elasticity. The elasticity of demand for a good or service is a percentage change in quantity demanded of that particular good or service divided by a percent change in the price of that good or service. Because the price elasticity of demand shows a responsiveness of quantity demanded to a price change, assuming that other factors that influence demand are unchanged, it reflects movements along the demand curve. With a downward sloping demand curve, price and quantity demanded move in opposite directions, so the price elasticity of demand is always negative. A positive percent change in the price implies a negative percent change in the quantity of demand, and vice versa. Computing the price elasticity of demand. Finding the price elasticity of demand requires that we first compute percent changes in price and in quantity demanded. We calculate those changes between 2 points on a demand curve. Then we measure the percent change between 2 points as a change in the variable divided by the average value of the variable between the 2 points. This measure of elasticity is called arc elasticity, which is based on percent changes relative to the average value of each variable between 2 points. What is price elasticity? Price elasticity is how sensitive demand or supply is to price changes. The formula is the absolute value of the percent change in quantities divided by the percent change in price. And if you're unaware, percent change is defined as the new value minus the old value divided by the average of the old and new values. That's how we calculate it when we are doing elasticity. For the types of elasticity, if the elasticity is less than 1, then we call that inelastic. If the elasticity is greater than 1, we call that elastic. And if the elasticity is equal to 1, we call that unit elastic. Suppose the initial price is 80 cents and the quantity demanded is 40,000 rides per day. We are at point A on the curve. Now suppose the price falls to 70 cents and we want to report the responsiveness of the quantity demanded. We see that at the new price, the quantity demanded rises to 60,000 rides per day. Point B. To compute the elasticity, we need to compute the percent changes in price and in quantity demanded between points A and B. The demand curve shows how changes in price lead to changes in the quantity demanded. A movement from point A to point B shows that a 10-cent reduction in price increases the number of rides per day by 20,000. A movement from point B to point A is a 10-cent increase in the price, which reduces the quantity demanded by 20,000 rides per day. We measure the percent change between 2 points as the change in the variable divided by the average value of that variable between 2 points. Thus, the percent change in quantity between points A and B is computed relative to the average of the quantity values at points A and B. The percent change in quantity then is 20,000 divided by 50,000, or 40%. Likewise, the percent change in the price between points A and B is based on the average of the two prices, and so we have a percent change of negative 10 cents divided by 75 cents, or negative 13.33%. The price elasticity of demand between points A and B is thus 40%, divided by negative 13.33%, or negative 3. Production cost. Total cost is the combination of fixed cost and variable cost. Fixed costs are expenditures that do not change regardless of the level of production, at least not in the short term. Whether you produce a lot or a little, the fixed costs are the same. Variable costs, on the other hand, are incurred in the act of producing. The more you produce, the greater the variable cost. Average total cost, sometimes referred to as average cost, is the total cost divided by the quantity of output. Average variable cost is obtained when variable cost is divided by the quantity of output. Marginal cost is the additional cost of producing one more unit of output. The increase in total revenue from a 1 unit increase in quantity is called marginal revenue. Thus, the marginal revenue equals the slope of the total revenue curve. Each total revenue curve is a linear upward sloping curve. At any price, the greater the quantity of a perfectly competitive firm sells, the greater is the total revenue. A firm's total revenue is found by multiplying its output by the price at which it sells that output. For a perfectly competitive firm, total revenue is the market price times the quantity the firm produces. Price also equals the average revenue, which is the total revenue divided by the quantity. Marginal revenue equals the market price, and for the perfectly competitive firm, marginal revenue equals the price equals the average revenue. marginal revenue is less than the price for a monopoly firm. Here we have a marginal revenue example. Bob used to sell 10 pencils, and now he is selling 15. Earlier, his total revenue was $20, and it is now $28. What is his marginal revenue? This is the formula, the change in total revenue divided by the change in total quantity. So his marginal revenue is 28 minus 20 divided by 15 minus 10. That means his marginal revenue is $8 divided by 5, which is $1.60. Profit maximizing behavior is always based on the marginal decision rule. Additional units of a good should be produced as long as the marginal revenue of an additional unit exceeds the marginal cost. The maximizing solution occurs where marginal revenue equals marginal cost. Here we see examples of industry structures. A monopoly is one firm, for example, a cable company in the area, like Comcast or something like that, or your water company. An oligopoly is when you have just a few firms, such as cell phone providers or airlines. In monopolistic competition, we have differentiated products, such as movies and novels and all sorts of things. On the other hand, in perfect competition, we have identical products, such as the different companies that sell milk. So now we will talk about perfect competition. This is a theoretical benchmark of a market structure. In this benchmark, we make 6 major assumptions. 1. All firms sell an identical product, which means that they are homogeneous. 2. All firms are price takers, which means they cannot influence the market price of their product. 3. Market share has no influence on price. 4. Buyers have complete or perfect information about the product being sold and the prices changed by the firm. 5. Resources such as labor are perfectly mobile. And then 6. Firms can enter and exit the market without cost. Step 4 in the project is when you research on the internet and discuss world oil price movements. For example, in 2019, it was reported that an oil price risk premium is back after attacks in Saudi Arabia wiped out 5% of the global supply. To do this section of your project, simply do a Google search for OPEC versus U.S. oil production and then write up what you find. Step 5 of Project 1 is to prepare your executive summary. An executive summary is a brief document typically directed at top-level managers who sometimes make decisions based upon the reading of this summary alone. As a result, the executive summary must be concise but comprehensive. You should include the purpose, the problem, the methods for analyzing the problem, the results of your analysis, and any recommendation. Also, please include facts and figures to support your claims and results. Here are references for today's discussion. If you're interested, feel free to pause this video to get a closer look at these references for your additional research. This concludes today's lesson. Thank you very much for watching.